This edition of the Bio Report is brought to you by the California Technology Council, providing discounts on products and services essential to every startup. For more information, visit californiatechnology.org/member benefits. I'm Daniel Levine, and this is the Bio Report. The MedTech industry has enjoyed robust M&A activity, strong financings, and a rise in R&D investments. But other numbers point to troubling developments that threaten the future health and growth of the industry, according to a new report from EY. We spoke to Ellen Licking, EY Life Sciences lead analyst, about the report, concerns about the venture capital industry's move away from the sector, and questions about who will fund early-stage innovation that will be necessary for the future growth of the industry. Ellen, thanks for joining us.
Thanks so much for having me. It's a pleasure to be here.
We're going to discuss EY's new global MedTech report and the state of the MedTech industry. There are some positives here, but I'd argue that there's much the industry should be concerned about that's in your report. Let's start with what's good news in here, which is often tempered. Make the case for why the industry should be optimistic. What's in the numbers that should give us encouragement about the long-term health of the MedTech industry?
Sure. I think as we noted in this year's report, we really see a lot of the financial performance and deal-making metrics as kind of a Rorschach test. Optimists are going to find things to gravitate toward. Pessimists are likewise going to find key statistics to latch onto. On the positive front, there's no denying it was a robust market for IPOs. It contributed nearly $2.3 billion to the annual financing total, and it was also a very healthy M&A market. Now, in terms of total deal numbers, we didn't see as many tech M&As in 2014, 2015 as we did in the year prior. But, for deals valued at less than $10 billion, we did see the average deal size increase. And that was driven partly because we saw a number of deals in that mid-sized range between $1 billion and $10 billion. And so, as companies, the bigger companies, the acquirers, are looking to focus their businesses and also achieve critical mass, they are acquiring other companies. And that's been a positive for the industry overall. And I think the third metric I would point to relates to the uptick in R&D spending. Now, R&D spending increased 6% in 2014 to just over $14 billion. That's the fifth year in a row we've seen an increase. Equally important, though, this uptick comes at a time when companies are returning less cash to shareholders via share buybacks and dividends. And we did go through a period in the post the global financial crisis where a lot of the capital allocation was really driven by short-term priorities and keeping investors sweet in MedTech stocks via returning cash to shareholders. And I'd argue that, it's a very subtle rebalancing in capital allocation, but it does suggest that particularly the bigger companies, the commercial leaders in the MedTech space, are thinking about focusing on activities aimed at future growth. And that's, I think, an important signpost to watch in the coming year and for next year's edition of the report.
The industry raised an impressive amount of money in the 12 months ending in June 2015. A big portion of that, though, was debt, and that was concentrated in a handful of large companies that were financing acquisitions. What can you say about innovation capital? How much was raised that would fund innovative companies, and how did that compare historically?
Well, you're right. And I want to begin actually by just defining what we mean by innovation capital for listeners. This is the money raised by companies with less than $500 million in revenue and As such, it's an important bellwether for the financial health of earlier stage companies, those companies that you can think of as the wellspring for future medtech innovation. And again, this is one of those worrisome signs that you alluded to in your opening remarks, Dan. In 2014-15, innovation capital fell 12% to around $13 billion. It's the second consecutive yearly drop in innovation capital, and it's coming at a time of a positive IPO climate. I think what's more worrisome about this scenario is actually the sort of concentration we're seeing in the marketplace in terms of which early stage companies actually have the capital. And what we're seeing is a concentration of that cash into the coffers of a smaller percentage of companies. And that means that the disparity between the haves and the have-nots in medtech is growing. And just to give you some numbers for this, we looked at this, and when you look at financings of greater than $50 million, in this most recent period we tracked, they accounted for about 50% of all the innovation capital, around $7 billion. But in 2008, at the nadir of sort of medtech financing, it was just 22% of the total were these big bolus financings, and about $1.6 billion. And so again, this just suggests that the cash is getting concentrated in a smaller number of companies. And so the companies that have it, that's great. But for the companies who are looking to raise money or have interesting, innovative ideas, it's a real struggle.
In terms of companies that completed IPOs, it seems medtech companies tended to be more mature than their biotech counterparts. How did the medtech IPOs in general compare to the biotech IPOs in terms of capital raise, stage of company, and aftermarket performance?
Mm-hmm. Well, so you're right. Historically, medtech companies have those that have been able to access the public markets via IPOs have been more mature than biotechs. We don't have the same dynamics working in the medtech space as we do in the biotech market. And so this was not a shift in a trend in 2014-15. This has been kind of a continuation of just the way the market dynamics work. And one of the major differences, I would say, between biotech and medtech, in terms of the total dollars raised, in 2014, biotechs raised close to $7 billion, $6.8 billion in 95 deals. And these are biotechs who listed in the U.S. or European exchanges. More than 50% of those companies priced within or above the range. During 2014, for medtechs, there were 45 companies that went public on U.S. and European exchanges, raising about $1.7 billion. You can see the dollar total is less. I think from a 2014 perspective, in terms of pricing, less than half of those companies actually priced at or above their expected ranges. So, at least in 2014, 50% of them, or more than 50% of them, took haircuts. Now, 2015, biotech year to date, we've seen about 60 deals and over $4 billion raised via the IPO market. For medtechs, we've had many fewer deals. We've seen 23 deals through September 2015, raising about $1.4 billion. But that is, a healthy IPO market consistently for the medtech sector. And I think, in terms of their ability to price within or above their expected ranges, medtech saw a real improvement in that in 2015 as compared to 2014. So more than 50% of those companies were pricing within or above their ranges. So, that's a healthy sign. And those companies that are getting out, I think aftermarket performance has been strong. So, again, I would say the major difference is you're not seeing the kinds of valuations you see with biotech. We are not seeing the pre-commercial companies with billion-dollar valuations in the medtech sector.
Well, the big area of concern that comes through here is venture funding, particularly for early-stage companies, which raises concern about future innovation and growth in the industry. How is the industry done overall with venture funding?
You're right. One of the things we flag in this year's report is what we call a persistent vacuum in venture financing, particularly for early stage companies. It's interesting when you go back and look overall at venture investment through the years, and particularly in the period after 2008, what we have seen is that venture financing has held remarkably steady. And I think when we first looked at this actually last year, we were a little bit surprised because I think that, talking to VCs in the industry, talking to entrepreneurs in the industry, there is this notion that, it's just much tougher to get funding right now. And what we saw actually was that the venture dollars hadn't really fallen off a cliff. They'd held remarkably steady in the sort of $4.7 billion range. But it was this new lower normal. And, it's as if the amount of capital and venture investment got reset in the wake of the global financial crisis. Now, that said, I think what's more worrying is that just in the same way we're seeing that concentration of capital from an innovative capital standpoint in the hands of fewer companies, we're seeing early stage funding erode much faster. And so in absolute terms, the dollars devoted to early stage financings, and we define those as seed, Series A, or Series B, dropped in the period that we most recently tracked to less than $1.3 billion. And, if you track the total flows of capital in percentages, that equated to just 29% of all of venture investment in MedTech going to companies that were raising those seed, Series A or Series B rounds. And that's worrisome, as you point out, in terms of, are the entrepreneurs who are developing the next generation MedTech innovations able to get the funding they need to really begin to push their new devices forward and test them. Now, I will say that, we did talk to two VCs, Josh Mackauer of NEA and then Antoine Papernak of Sofanova, about this topic for the report, and their perspectives are included in this year's edition. And what both of them said is, while they're worried about this, there are still a number of really fantastic and exciting opportunities in MedTech. And Antoine's perspective really is that there has been some rationalization. This is forcing, from an economic perspective, that the notion that the truly best companies and the ones that really have innovations that are breakthrough and are going to change sort of the delivery of care are the ones that are actually getting funded, and to bear that in mind.
Well, what's accounted for the lack of venture capital interest in the space, and what will it take to reverse that?
I think it's multifactorial, right? I think, in the wake of the global financial crisis, limited partners who invested in venture, looked at their own portfolios and reallocated their distributions. They looked at the returns they were getting for MedTech. And at the time, in the wake of the financial crisis, there wasn't a robust IPO market. We had this period where the regulatory climate got much more complex and difficult. And so the time frame to get a product to market, which has always been the kind of gatepost for success in terms of being acquired or going public, lengthened as a result of that. And we also entered a period where reimbursement became a big issue, and hospital systems and payers were themselves consolidating, and that created a lot of uncertainty, and the market doesn't like uncertainty. And I would say, the reimbursement climate or the regulatory climate, has improved dramatically, and there's much more optimism about the ability to work with regulators and the clarity that regulators are providing about what data are required or not required. I think reimbursement is still a really big uncertainty. And when you talk to executives in the field, they discuss the fact that, payers always come back wanting more data. There are always more data desired to show the value for a product. And I think you've seen MedTech broadly, particularly the bigger stage companies, think through that dynamic and look at how they can access different kinds of technologies to begin to collect that data, whether it's digital technologies, whether it's taking advantage of new advances in sensors and monitoring that begin to showcase the value of a device.
There's some reference in the report to the investment activity of strategics, but it doesn't seem that the conventional medtech giants have played the same type of role as investors in early stage innovation as their counterparts in the biopharmaceutical industry. What are you seeing in terms of activity from strategics?
So there are a number of strategics that are very committed in the marketplace. You're right, they haven't played as big a role as corporate venture in the biopharma space, but we anticipate they will be have a bigger share of voice and play a bigger role sort of in this next period, and it'll be a signpost that we watch for. I think, in the biopharma space, in the wake of the global financial crisis, when biopharma itself retrenched, there was a lot of angst about who was going to fund innovation. And then a couple years after that, you really saw the corporate step up, and they were leading rounds, and they were being very committed in the marketplace and continue to do so. And I think you're starting to hear a lot of that vocalization. I would say the other thing to keep in mind is that as we have this convergence between med tech and tech, and you're starting to see some new players come on board that represent new pools of capital. So I do think traditional tech companies that are moving into the healthcare space do represent an important new source of capital, and that's one to watch for. So it's not simply the Medtronics, the Becton Dickinsons, the Zimmers of the world, in our classic therapeutic devices. It's also the Googles and the Qualcomms and others.
The other thing we don't seem to see is the same type of investment in university research that we see in the biopharmaceutical industry as a way to tap early stage innovation. Any thoughts on why that is?
Well, I think the model is different. I mean, and in the biopharma space, you have big efforts in translational medicine, and really moving beyond sort of that bench to how it would be used in patients. I think in the medtech space, we have a vibrant community of incubators, and we've had, I would point to the Foundry and the Innovation Factory, which are stalwarts in the incubator space, but other groups like Exploramed that have played a key role here. And I would say that universities are conscious of this, and you're starting to see them take a more concerted effort. So I would point to what's happening in San Francisco, and the Reisman Institute, which is a new medtech incubator that's kind of an offshoot of the biopharma incubator QB3. And then also, another one I'm very close to, given my location in the peninsula in California, is Stanford and what they're doing with the Stanford Biodesign. And I think they're bringing together lots of people, and that's creating a community of entrepreneurs, and is bubbling up to really drive those innovations forward.
The industry is fast to point to regulation, reimbursement, and taxes as the reason that venture investors have fled the space and the need to address these issues. But when I think back to the financial downturn and the biotech industry's policy agenda, the focus was much more on direct incentives to investment and lowering the bars on access to capital. This is an industry that is still very much driven by a handful of large companies, where something like the tax from the Affordable Care Act has much more meaning than to an early stage innovation company that is concerned with capital formation. What impact does this have on creating a meaningful innovation agenda for the industry?
Well, I think there are important signposts in place. I think AdvaMed has put forth its own innovation agenda this year to really jumpstart the conversation and show that, yes, it's aware that this is potentially an issue. And, I think the big MedTechs themselves are conscious of the fact that they can't keep coming back with low single-digit revenue growth year over year. It's not something that's going to excite investor enthusiasm. And so, I think the steps that have been discussed and are in place, at the macro level, seem to be the right steps. It's going to take time to play out. And I think one of the things that concerns sort of the entrepreneurs and the venture groups that back those entrepreneurs in the short term is we've seen, because of the more difficult regulatory and reimbursement climate, the shift that I spoke of earlier of companies wanting to focus their business models and create scale so that they can think through having a portfolio of products to go to payers with, right? The outcome of this emphasis on focus and scale, of course, has been a consolidation at the top of the industry, and it has led to fewer acquirers for, the more innovative companies. And I think, one concern in the interim that many entrepreneurs and VCs have, that when we spoke to for reporting this edition of Pulse, was how that was going to affect valuations for those new companies that are coming up. And, if you only have 2 or 3 potential acquirers for your particular technology, how do you develop relationships with those 2 to 3 companies now and make sure essentially that they're aware of what you're doing, why it's important, and are building in sort of the specs that are going to make it an important device in the marketplace.
Ellen Licking, EY Life Sciences lead analyst. Ellen, thanks so much for your time today.
Again, thank you so much. It was my pleasure.
Thanks for listening. The Bio Report is a production of the Levine Media Group. To automatically download this podcast each week, subscribe to our RSS feed or through iTunes or other podcast manager. To join our mailing list, go to levinemediagroup.com. We'd love to hear from you. If you want to drop us a line or are interested in sponsoring this podcast, send an email to danny@levinemediagroup.com. Special thanks to Jonah Levine, who composed our theme music, and the Jonah Levine Collective, which performs it.